Good afternoon, everyone. My name is Sriram from the Commodity Research Desk. Welcome to the weekly commodity market updates. Beginning as usual with the bullion side of things, international spot and domestic markets, both gold and silver, witnessed volatile trading last week. Earlier, prices had risen amid uncertainty surrounding the rates from the US Fed. However, after the brief upside, markets witnessed a correction by the end of the week. The FOMC minutes showed that US Fed latest policy flagged uncertainty about the timing of the potential rate cuts. The Fed official did talk about falling inflation and concerns around the restrictive policy, but gave no indication on when the rate cuts could begin. So this uncertainty pushed the investors towards the safe haven appeal of the dollar, and the bond yields also moved back above the 4% mark, and this pulled the prices lower. Additionally, the dollar and the treasury yields also moved up higher after a report showed that US added more new jobs than expected in the month of December. Looking ahead in the coming week, we see the key trigger will be the US inflation numbers. Again, data will, apart from that, the other data will also take center stage, but with the key inflation gauge moving the markets, prices could continue to remain range bound till that inflation number is out on Thursday. Of course, the higher inflation will pull prices lower as traders will reconsider their expectations for an early interest rate cut as early as March. So the key inflation numbers will be a key trigger for the markets, at least in the short term. Any signs of course, sticky core inflation will also be looked out by the investors, and that will augur poorly on early interest rate cut by the Fed, which will continue to keep prices under pressure going forward into coming week. So till that time, we feel markets will remain range bound and will remain caught in the tug of war as investors try to anticipate the next next move from the Federal Reserve. Some support could come in the form of geopolitical concerns as Middle East crisis escalates, but overall we feel the inflation numbers will be the key trigger. Other notable data include US PPI number, balance of trade, wholesale inventories, and the weekly jobless claims. On the chart, we feel COMEX February contract range is anywhere between 2025 on the lower side to 2080, 2100 on the upside, a broad range for the markets this week around. Domestically, the range is anywhere between 61,600 to 62,700 for the coming week or so. Moving to the energy side of things, starting with the oil side, international and domestic oil settled higher last week after boosted by signs of underlying strength in the US economy, as well as potential for supply disruptions in the Middle East as the tension escalate there. However, the rebound in oil was capped by data showing a massive build in inventories, especially on the product side. Both gasoline and distillate inventories rose by over 10 million barrels last week, and this pulled kept the markets upside limited. The reading also indicated that demand remained weak in the world's largest fuel consumer. Of course, briefly on the gas side of things, gas prices surged last week on forecast that extremely cold weather front is expected in mid to late January. That will boost demand for the fuel. Prices did witness some correction during the week after a bearish EIA report, weekly inventory report, but markets shrugged off those bearish report and continue to focus on the weather. Looking ahead, we see gas prices will continue to move higher as more cold weather is expected in the US, at least in the Northeast. There is also predictions that Texas could also witness some more cold weather, and that will boost demand for the fuel. So gas prices will continue to or could continue to move higher. We see the range for the gas prices internationally between $3 on the lower side to $3.4 on the upside, while domestically we see a big range of 245 on the lower side to 285. On the crude side of things, oil prices can remain range bound in the coming week. A rise in OPEC production will cap upside. Additionally, recently, as we know, on Sunday, Saudi Arabia also cut their official selling price to Asia to a 27-month low, and that will also keep the demand weak. However, ongoing political risks in the Middle East will cap downside. The next trigger for the oil markets will be the inventory data this week from the EIA, and along with that we have the US inflation numbers, which could have an indirect impact on the oil markets. On the charts, we feel oil prices can remain between $67, $67.50 on the lower side to $73.50 on the upside for NYMEX February. Domestically, January can remain between 5,800 to 6,200 in the coming week or so. Finally, on the copper side of things, copper prices tumbled last week, pressured by a stronger dollar. Prices started with gains on low inventories in the Shanghai Futures Exchange, but upside was unable to sustain, and most other base metals also witnessed correction along with copper prices on slightly on a recovering dollar and some profit taking by investors. Metal also was under pressure from uncertainty about demand in China. The manufacturing PMI numbers activity shrank for the third straight month in December, so that could continue to keep prices upside limited. Aluminium prices remained under pressure last week as raw material supply concerns eased and investors' optimism over early interest rate also waned going forward. The other metals also remained under pressure significantly last week. Looking ahead in the coming week, we see copper prices could trade range bound. A steady dollar will cap upside, but could be countered by support from low stocks and tight raw material in the physical markets. Higher, of course, the data will also play a big hand. Today evening, we have the new loans, Chinese total social financing, along with CPI and PPI numbers this week from China. That could be very key going forward, along with the trade numbers. That will be extremely key for the base metal sector going forward in the coming week and will move the markets. Apart from that, we have the US inflation numbers also there in the US, and that could have an indirect impact on the base metal sector going forward in the coming weeks. So markets are going to remain under pressure if the data is unfavorable going forward. On the charts, we feel MCX copper January contract will remain between 710 on the lower side to 730 on the upside of things in the coming week. So that's it from our side. Thank you very much for watching. Have a pleasant day and a week ahead. Thank you.